Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Craig Eppler. Craig is the founder of Eppler Capital Fund, or funds. In March of 2023, he opened that particular fund and serves as its chief executive officer since its inception. With a decade of investment experience, he brings deep knowledge and understanding of the asset management space. Craig started his career at Vanguard as a derivatives analyst, and he worked on the trading desk with domestic equity futures, cleared swaps, and variety of other derivative products. He then joined Hoover Financial Advisors, later merged with Wealth Enhancement Group, and was promoted to senior portfolio manager. Craig was a key member of the investment committee and developed strategies for both public and private markets. Craig has been investing in private assets personally as well since 2019. His real estate holdings company has purchased more than 40 rental properties across southern or south central Pennsylvania, and he also has numerous direct investments in private companies. Craig is a graduate of York College in Pennsylvania, where he received his Bachelor's of Science in Finance, as well as an MBA with a finance concentration. So, Craig, welcome to The Wealth Flow.
Thank you, Keith. That was a mouthful. It's weird to hear yourself in that light.
Yeah. It was a little bit of a... Yeah, and what I'll usually do, Craig, is just kind of start with your background. I love to hear everybody's background from where they grew up to, what led you to the financial industry and also to some real estate investing as well.
Sure. Yeah. I'll rewind the clock here. I grew up in the Lehigh Valley, so Bethlehem, Allentown, Pennsylvania. For those who are familiar with the area, it's about an hour and a half north of Philly and about an hour and a half west of New York City. So kind of cross between those two areas. Grew up, my dad was a CPA. My mom was in marketing. My first kind of intro to finance, I've always been good at math, but as the math got harder and kind of more theoretical, I kind of zoned out a little bit. I like the more practical end. So in middle school, my dad was taking some sort of stock trading class, which was the hot thing at the time. And part of this class that he paid for, you would go up to Boston to sit on the trading floor there and sit with a trader and kind of see what they did for the whole day. And he asked if I wanted to come. At the time, I put my life savings into one stock, which was about $1,000 at the time, which is a cool thing. And that's back when the commissions were high, and it was a way different world than it is today. But anyway, we went up to Boston and we sat with this stock trader for the day. And I remember to this day, the first thing he said, he was a little bit late to the meeting. And he said that he made a trade this morning that made him $5,000. And that kind of sparked my interest. Like, how the heck did you make $5,000 before 9 a.m.? That's pretty cool.
Yeah.
So that's kind of, it's a really corny story, but that's kind of what sparked my interest. Took a few finance accounting classes in high school, which were very basic. But in my 18-year-old brain, that was good enough to major in it in college. And it ended up being a great fit. So kind of like you stated, I went to York College, which is central PA, about 2 hours west of the Lehigh Valley. Studied finance and accounting, did a 5-year program there and went straight through to get my MBA. And I was kind of exploring all these different routes of what I wanted to do at that point. I actually had 7 different internships during college, anywhere from working in New York on a kind of Wall Street type firm. I worked at Vanguard prior to getting a full-time offer there. I worked at an insurance company. I worked in a corporate finance company. Kind of you name it within like the financial space, I did it. Weirdly, not including any real estate firms. But I guess that'll be later on in like the story here. So I got the job offer at Vanguard, went there fresh out of school, moved to Philly, worked there for a couple years in the derivatives team, which sounds way sexier than it is. I was pretty much a junior trader for the guys, and they kind of told me what to do. Vanguard was a great start, but I wanted to kind of do more of the investment work and kind of looking at the actual deals versus just kind of taking orders from someone. So that's when I moved to a firm right down the street, which is in Malvern, Pennsylvania. For those who don't know the area, it's about an hour-long commute from Philadelphia. Not mileage-wise, it's very far, but time-wise with traffic, it's rough. So that's when I kind of dug into some podcasts, listened to a bunch of different things and kind of different ways to create wealth outside of your 9-to-5 job. And that's kind of where the real estate kind of came in. I heard of the house hacking through the on Bigger Pockets back in the day. Bought a house right down the street from where I worked in Malvern and house hacked that. So I bought a 3-bedroom house and I rented out the other 2 rooms, paid for the vast majority of my rent. And that kind of started the real estate journey, right? So I went from that first unit, bought my first rental 2 years later. And then starting in 2020, I went from 2 units to 48 units within 2 years from there. So I went a little hog wild during COVID.
Yeah.
So I will stop there, but I mean, the story keeps going, but I'll stop there. There's probably some questions you want to kind of sprinkle in.
Yeah, for sure. No, I appreciate appreciate that, Craig. First of all, that going way back to your story with your dad taking you along with them to Boston. That seems it's really cool. How old were you at the time? I'm sorry, I may have missed that piece.
I'm middle school, so what is that? Yeah. 12, 13 years old, right? Something like that.
Okay. Yeah. And then did your dad end up doing much with the course beyond that? You said he was, I believe, a CPA. Did he do quite a bit with it after?
Yeah, I mean, honestly, not much. It was more exploratory. To be a good day trader, you got to be in front of the screen all day. I think that kind of lost its allure after a bit, I think.
Yeah. But either way, what a great experience for you and what an impression it sounds like it made on you. So that's awesome. And then we can maybe, I guess maybe for the audience and for myself as well, explain the derivative. I've heard the term, but don't really know what is a derivative trading.
So, I mean, so it's a different type of investment asset, right? So there's a bunch of, it's the overarching term that includes swaps and futures and options. There's other things that are thrown in there as well, but not to bore the listener. So they're mostly indexed and kind of financially engineered products to either hedge risk or enhance risk, right? So it's to add leverage to a portfolio or to lower the risk within your portfolio. You can set it at different price targets. There's different special accounts that you need to trade these as well, and I wouldn't recommend trading them unless you've done a lot of research on it. So
yeah, for
not
sure.
sure that answers your question, but.
I think overall it is. So it's not an individual stock. It sounds like you said indexed, which I assume means it's multiple stocks of
right over the S&P 500 or exactly.
Yeah. Okay. Interesting. All right. And then what? From there, let's talk a little bit about that journey with the houses. Obviously, house hacking, living in one, renting rooms out for the others.
Sure.
Makes sense, and certainly offsets that most people's major expense each month is their mortgage, and so you've kind of taken a big piece of that out of the equation for yourself. And then you bought it sounds like an investment property after that. But that's a very short time frame to go from one property to, you said, how many did you end up with? 40 rental properties?
Yeah, 44 I'm at now, yeah.
Yeah. Okay. Yeah. So tell us a little bit more about that journey.
Yeah, so was doing the house hack, which removed the vast majority of, like you said, like my monthly expense there. I think I got my monthly expense with my mortgage, and there was an HOA in that community and everything. It was down to $500-600 a month, which was great for a mortgage that was $2,200-2,400. So that kind of gave me the ability to save a little bit more. I bought that first rental in 2019. And every real estate horror story you read of, it happened in that first one, right? I bought it. I bought it well, but the tenants stopped paying right away. Had to evict them over the winter, which the winters aren't terrible here, but they're cold enough that most people don't want to move.
Yeah.
So I had to evict them. Took a while to fill the unit, and meanwhile, I'm financing this with my 9-to-5 job, which was stressful at the time. So kind of licked my wounds a little bit for another year and a half before I started to buy more. I found a credit union locally that was actually able to give me a home equity line for 100% loan to value, which I had a tailwind from my first residence, and actually got some equity in this thing fairly quickly. So I was able to draw on pretty much like what I put down into that property plus a little bit of growth, and started writing checks for the next few properties. So that bought me the next 16 units, or bought me up to 16 units. And those I bought as kind of package deals. I would get, I'm super creative with how I finance these. My whole goal was to get as many units as I could. So I would try to get seller credits. I would try to do different things to put as little money out of pocket as possible when I was buying that portfolio, or these little portfolios. I buy 3 single families or a quad, or kind of something like that. And then after that, I was at a family function, and my parents or someone had been talking to one of their friends about me doing real estate, and it's a cool topic to bring up at like these parties, right? And they're like, oh, that's cool. I'd be interested in putting money with you. This is back when rates were lower. So they said, if you find a deal, let me know. And I found this 32 unit deal. It was a bunch of single and small multifamily homes, all in one neighborhood in a Harrisburg suburb. And I kind of brought it to them. They're like, yeah, I'm in. So they came up with a down payment and a little bit of cushion. So they took that second lien, and I was able to buy that portfolio to really, that was the big chunk of it, right? To go from 16 to 48 units. And since I sold the quad, down to 44. But at the time, I was up to 48 units. So,
wow.
Between a line of credit, which is leverage and is sometimes risky, between that and raising a little bit of money, is how I went from 2 to 48 in a pretty short time frame.
Yeah, yeah. So you raised some capital on that 38 unit, and then what did you do? Was it owner finance? Did you use the credit union or the bank to finance it? Or
yeah, so they did. So they financed 80% of it. I had to come up with a 20% down payment on that purchase price. But the way that I structured that deal is, and I don't even know if you could do this anymore, to be honest with you, is they had a number in mind of what they wanted to kind of sell this thing for. And it was pretty far off of where I wanted to sell it, or I'm sorry, where I wanted to buy it. But they were really okay with giving me a massive seller credit if I was able to buy it at that number. So they gave me a seller credit for about 12 to 15% of the down payment. So it would show up as that purchase price. It just had to appraise at that value, obviously, which it did. But they gave me a well into the 6 figures seller credit to purchase this property. So I only had to come to the table with $100,000 when normally it would have been closer to $600,000 to buy this like 32 unit portfolio.
What do you think? What was their motivation for wanting to sell it at a higher price? Just being able to say it sold for a higher price,
I really think that's what it was. It's honestly, it's really hard to kind of believe what people's motivations are here, but I really think they just wanted to sell it at that number and say that they got that number for it, which blows my mind to this day. But it helped me out. tremendously because I don't think I would have been able to raise that much more money. This one guy wasn't able to write that much more of a check, right?
Right, exactly. So was that part of the 20% then? Was that seller credit, and then you just raised the remaining balance of it?
Correct.
Okay, wow, that's perfect. Yeah, it's always neat to see how some of these deals can be structured. I mean, really, the sky's the limit, and there are a lot of different things you can do. And here's one that you would think, would a seller be willing to sell it for X amount ahead, give you this huge credit? Most people would think that wouldn't be something that that can happen, but
Right.
it certainly does, and it happens quite frequently actually. So
and I think the interesting part about this deal is most people are always trying to find deals, right? And I was as well. I wasn't really, because I was looking to kind of make this like the next step up from 16 units to something a little bit bigger. And you can go on like LoopNet and all these sites, but those deals have been come through hundreds and hundreds of times. So it's tough to find deals there. I'm not saying you can't, but it's just tough to find deals there. This portfolio is actually listed incorrectly on Zillow. Is how I found it. So it was listed as a single family unit in this town where you at the time units were selling anywhere from 60 to 80 grand per door, and there was this house right in the middle of this town for 2.7, 2.8 million. So it was listed on the market for like 200 days. And no one had listed, there was no pictures. There was just a description that said 32 unit portfolio. That's it. Right.
wow.
So it was just mislisted.
Yeah.
And no one, I guess, like the people that would want to buy something like this just didn't take the time to look on Zillow for a $2.7 million, like I'm single family home in this area.
Yeah.
So a mislisting helped me out a lot on that one.
For sure. Yeah, I found deals like that as well, whether it be, mislisted on the MLS, maybe the agent didn't do what they should have. I haven't found too many on Zillow, but certainly, those are kind of neat
Right.
to be able to run across them like that. So
100%.
Well, cool. Well, let's maybe shift gears a little bit and talk a little bit about your fund and specifically, what kind of an investment is it?
Yeah. So I'll kind of continue the story to kind of give the full circle here. So
Sounds good.
So I worked at that firm for a bit, and like you said, I did some private investing there with our clients while I was doing the real estate. So the private stuff really kind of struck my interest. It was kind of like real estate was like the building block, and then the private stuff was like that next step for me. I did have the background in it a bit from work, but really the problem that I saw when I was working with these kind of mass affluent clients, when I was at my old job. I was on the portfolio team, so I wasn't dealing directly with clients. But if a client had a question about their portfolio, whether it be a real estate play we were doing or a private equity thing or a stock or bond, whatever it was, I was kind of brought in to be the quote unquote expert for that, right? And kind of talk through what that was. And really the thing I heard over and over and over again for these people who on average were about 60 years old and were worth anywhere from $1 to $5 million was really our like bread and butter client. Those people, honestly, the vast majority of them really just wanted consistent income. Yeah, they cared what was in their portfolio, if it was a stock or a bond or whatever, but they just wanted to make sure that they would have enough kind of through their retirement, leave their kids something, that they would have the income to play off that. They were more worried about losing money in like the stock market than having some massive return in some like a mega cap stock, right? So with that, I was like, okay, well, I feel like the private market, at least in some of the stuff that I put my money into, is a lot more predictable over the next 3 to 5 years than the stock market is. And I've heard over and over and over again that these people just want income. So if I can kind of combine this like very traditional financial route with the private investing route and kind of marry them, I can come up with a fund that people just want income, right? So that's where I created the fund. It's a Reg D 506C offering for all of the legal jargon there, but clients have to be accredited, but the fund is like very simple. It's a promissory note fund. The client puts money in, they get a fixed 9% return. The distributions are paid monthly. That was another thing I saw a lot. People didn't like the variable kind of like distributions. They wanted the same thing every single month. So I structured it that way. And the client gets to choose whether they're in from anywhere from 3 to 7 years. And the fund is backed by small businesses. So these are small to mid-sized businesses, usually doing anywhere from $2 to $20 million in earnings. So they're real businesses, right? They're not like baby businesses, but they're also not these mega cap stocks. And they're in old school cash cow businesses that kind of print cash, honestly. And in most of the deals that we put money into, we have first lien and everything is asset backed by something that's a hard asset. So I'll stop there.
Okay.
It's an interesting niche.
Very interesting. And so they've got a choice of 3 to 7 years. Is it 3 or 7 years or anywhere
3 to
within
7,
that?
So we do 4, 5, 6, or 7.
Okay.
Yeah.
And then are those promissory? You said it's promissory notes to those businesses. So you're not actually buying. The fund isn't buying the businesses; they're lending out to these businesses. Is that correct?
It can be a debt plus equity on the deal with the fund and the actual companies, but the end client and the fund, it's a note between the fund and the client. Does that make sense?
It does, and I assume that these businesses, like from a risk standpoint, these are businesses that have been in business for a little while. So there is some kind of a track record that
100%.
you can look at and say, from a borrowing standpoint, they should be solid. Or tell us a little bit about, what types of businesses these are, and how long they've typically been in business, and then I guess. Maybe a follow-up to that would just be, what are they typically needing this type of cash injection for?
Yeah, so I think the best way to kind of talk through this is to give an example of what's in the portfolio. I guess to the first question, the average length that these guys have been in business is 20 to 25 years. So these aren't new companies. They're not the new sexy AI company. It's stuff that people need or stuff that the market's needed for a long time. And I think we'll continue to need. So I'll give you an example. The largest holding in the current portfolio is this airplane group. And what this guy pretty much does, he's been in the industry of doing this himself for 25 years. He buys old, 30 plus year old airplanes that are not in use anymore and kind of past their useful life. But during the course of their life have been able to be replaced with parts and things like that. So he brings them down to his warehouse. He actually parts the planes out and sells and leases the parts back to different airline groups. So it can be like the big airlines. It can be to different private jet companies. But he can turn these things, depending on the size of the plane, anywhere from 90 to 180 days. And the margin on that is pretty awesome. And the fund has a lien on the airplanes that are in his warehouse. And really, I guess to your question of why does he need this capital? This guy kind of, I met this guy through my connection who's doing more like the e-commerce stuff. This guy that was doing the airplanes was really just doing it off of his cell phone. He had all the connections, and he would just call the guy up and be like, "Hey, do you need XYZ part?" And that's how he was doing business. So my contact kind of came in, made it more, they kind of put it online, right? So they could go on and see, okay, there's this left rear engine. Here are the specs. We can go online and kind of not click buy, but, see everything there instead of giving this guy a call. And it was really just to make the business bigger. So they bought another warehouse, they hired more staff, and the money that the fund is giving to this group is just acting as a line of credit, really, for when they want to buy new airplanes, so they don't have to take on bad debt. And the fund has a deal with him, or not him, with at his firm, that it's a convertible note. So we get a debt percentage, and we get a quarterly profitability upside. So I know that was a lot of jargon in there, but that's an example of kind of one of these little businesses that I don't see airplanes going away anytime soon.
Yeah, no, that makes total sense. And I could see how having the ability to have that line of credit would be important for him.
Yep.
And obviously from an investor standpoint, having a 9%, it's a predictable return. You're going to be getting it, and it sounds like monthly distributions. You get to pick the term of how long you want to hold. Is there a difference in the distribution amount depending on whether it's a 3-year or 7-year, or is it just consistent across?
So it's flat right now. It's subject to change based on where interest rates go, but right now, if you look at the yield curve, right? You're getting about the same interest rate if you were to buy a U.S. Treasury bond for 3 months or 5 years. So I
Yeah.
tried to mirror that in my offering. Now, if rates go down or go up, I'll have to adjust, obviously, based on that. I think most people want a little bit more yield for a longer term, but I want to actually match what's in the market right now. And that's kind of what I'm seeing. And again, this is all subject to change, but as of today, it is all flat across the board.
Okay. And so that's one example of one of the individual loan types. What are some other types of businesses that you are investing
Sure.
with?
I'm investing in a group that does regional franchises. So they do things like jazz clubs, they do pizza shops on college campuses. So stuff that's frankly pretty predictable. Kids eat pizza in college, and I think they will for a long time.
Yeah.
There's a group that I'm investing in, which I'm currently adding to. They do subscription boxes. So if you're familiar with the boxes that show up at your door each month for menswear or makeup or food or whatever it is, that's a pretty predictable kind of revenue stream there. And what the group that I'm dealing with does is they find the boxes that frankly have gotten into some bad debt. A lot of these box companies, I'm not sure why they do it, but they take on this MCA loan debt, right? The merchant cash advance. For anyone that's in that space, it's very high interest rate debt, and it's tough for them to get out of. And I get why they do it, because they have to buy the inventory for the next month, and they have to keep going. And you're almost taking from Peter to pay Paul kind of deal. So what my contact does is they go in. They give them, again, a line of credit kind of thing instead of using this MCA debt. And they take over 51% of the business. So the deal the fund has with these different box companies, and what he does is he's buying, 3, 4, 5 of these, and the goal is to roll it all up into one and then sell that off. So this is a 3 to 5 year play. And the fund has a deal where, it's a debt percentage every month, similar to like the airplane deal. And there's a royalty from each box. So every box that's sold over X, we get $1. And that's kind of like the kicker that we get on that. And I guess that's kind of leads to another good point is we're giving the 9%, and really that's smoothing out the return for the end investor. We like to stockpile cash while times are good, which frankly things are going really well right now. And the goal with the fund is to give enough cash reserves so that we have enough cash reserves for a full year's worth of distributions. Because as you know, in like the private space, things do go wrong. And I want to prepare now while times are good, instead of when it's raining hard and I don't have anywhere to put the rain. Right. So I'm stacking cash now. We're at about 5 months worth of cash reserves with the goal over the next year to build that up to a full year. So I know I'm dodging all over the place here, but that's
No, that's good though.
And what we're doing with cash.
That's real interesting. So there's not only obviously you're making money. I'm sure some type of a spread on what you're lending the money to these companies for, and the investors are coming along and getting a portion of that. But then in addition to all that, you've got these other plays that are happening that are allowing you to, like you said, stockpile basically the money so that you do have some runway if something were to go wrong, or there was something to disrupt some of the cash flows on your end. You're still able to pay out those distributions.
Exactly. Yeah. And then I guess the same deal with the airplane deal, right? So the box inventory, the fund has a lien on that inventory. So that's the hard asset backing that. Same with the franchises, right? We have liens on that real estate that they own. So same deal with all of these. There is some sort of hard asset backing all of these, which I think is a good story to tell and makes me feel more comfortable, because that kind of goes back to my kind of real estate background. Is it feels good for me to own something that's a hard asset. And I know it's not as easy to like transact inventory or these different franchises, but you do apply a multiple on these. That you get a better coverage ratio, frankly, with an asset that is less known than like a real estate transaction. So, for example, we have 3 times like the level of assets in some of these in these things than you would say if you were in like a second lien position. Not sure if that made sense or not, but
Yeah, it does. And then what about, is there a specific geography as far as where you're doing these investments and where you play ball, or is it pretty well? It just depends. It's wherever these companies can use.
Yeah, for sure. I mean, it's definitely U.S. based, but we don't have a tilt as to what area of the country that we do business in.
Okay.
If there's a good deal, I don't care if you're in like a Wyoming or Florida or PA, where there's a good deal and where the laws make sense. Based on the deal, it could be advantageous to be in certain states rather than others, but that's on more a deal by deal basis.
Is the playing field across the U.S. fairly similar, or are there very state specific things when it comes to this type of lending that you're doing? I would think, since it's not a consumer, it's more from a business standpoint, that there's not as many protections in place. I'm sure there's some, but are there hurdles that you're having to come over? In other words, is there some states that you're like, yeah, it's a little too complicated to do it out there, or is it pretty well you just need to know the rules?
Not really, to be really honest with you.
Okay.
So the private credit space, which my fund kind of falls under, has grown massively over the past 5 years. Banks have really tightened up in a lot of different areas outside of things that they really, really understand. So just for context, like the private credit space in the past 5 years has grown from 200 billion to 5 trillion, just as a market, which is an insane amount of growth. So a lot of these kind of private debt funds that the banks used to service, or like these private companies that the banks used to service, pretty much cut it off, and have really opened the door for funds like mine and others to come in and be that bank like asset backing thing. So I haven't come across any states that are frankly difficult to transact in. I'm not saying it won't happen, but as of now, there really hasn't been a lot, because I think the states like it, frankly, right? If the banks aren't like willing to lend, it's a positive impact for their state to have someone come in to invest in their state, right?
For sure. What about and what types? I obviously dependent on the business, dependent on the size of the loan and everything. I'm sure there's variables, but what are they receiving the money for? I don't mean what specifically are they going to utilize it for, but from an interest rate standpoint, what kind of rates are you guys able to charge?
Yeah. So again, each deal is very deal dependent. I would say a typical deal for us, I've kind of mentioned some of these debt plus upside deals. A typical deal for us is we're usually charging 12% plus upside, which on a good year might be upper teens. On a bad year, you might just get the 12, right? But I like that structure a little bit more. If I'm just doing debt, I charge 15%. And again, that allows me to stockpile cash and, give some for a rainy day, or give some cash to like the side fund for a little rainy day. A lot of private credit funds that are in the same space do use some leverage. So 9% for the space is kind of mid to low end in terms of yield, but I'd like to think from a risk perspective, it's a bit lower. You can go out and pretty easily find 12. But a good question to ask all these guys is how much leverage are you using? And even though it's usually fairly modest, 30% leverage can hurt if things go like the wrong way, right? So I've kind of made it a point to make it more conservative. I'm not trying to reach for yield, and the goal is I don't think that I will need to lower my rate when rates are cut, because I'm locking in these project terms for anywhere from 3 to 7 years. So. Well, those are usually like a variable rate. Mine is fixed rate. So.
Okay. Yeah, that's interesting. So on most of yours, it is fixed.
Yeah. And I've learned through the process that there are provisions in place that there's penalties if they do get out early, which would frankly make up for that difference in yield, if that makes sense.
Okay. Yeah. And then what about as far as terms for the folks that you're lending to? You mentioned interest rates and approximately where that's going to fall in line. Is that also going to be like a 3 to 7 year type of loan, or How does that? It just depends on what they need.
Yeah, so I try to match up my investor dollars coming in with the type of project length that I'm putting out there. Usually try to
Okay.
shortcut the project a little bit in terms of time frame versus the investor. Because if a project takes a bit longer, I don't want to make the call to the investor saying, "Hey, we're waiting on this project to come full cycle, so your cash is going to be 5 months late." Right? I want to have that cash 6 months before they need it and have it sit in a U.S. Treasury bond until they need the money. Right? I think a lot of my investors will end up re-upping and just keep it going, but I don't want to bank on that. I want to make sure that if they're up for their loan, and it's the end of the 3 to 7 year time frame, that they get their cash back. And that again ties into the cash reserves, just making sure that you're well capitalized going into these different events.
Okay. And what about when I think of fund and typically I'm looking at like real estate funds and there's multiple properties within that fund. But are you truly are you matching up 3 years with 3 years, and so all these that are 3 years go into a certain investment, or as people are investing with you, are they investing in an individual loan, or is it a series of
It's a good
multiple
question.
loans?
Yeah, a good question. Everyone gets a blend of all the projects that are in the fund.
Okay.
So currently the fund has 5 projects growing into 6. The goal is to get up to that 10 to 12 range. And as the fund scales beyond that, up to 20. But 10 to 12 is really the point that I'd like to get to. That makes sure that there's no more than 10% in any one investment. A lot of the funds that you're talking about and other private offerings really, a lot of the funds in the space really have like one project, right? So you're dealing only with multifamily real estate. You're dealing only with self-storage. I think by giving different sectors and different businesses and different states, it gives more of a smoothed out approach, right? So if something happens in one of these things, that we have 9 other investments. Right now we have 5 growing into 6, like I said. So the risk is a little more congregate in those, but the goal is over the next year or so, as we scale a little bit, to bring that up to 10 to 12. It's more of like a portfolio play, right? This is your alt debt part of your kind of like your whole portfolio, and and this is this is the one thing you need instead of having 5 different funds that do something like I'm very specific. I'm not sure if that made sense or not, but it's kind of tough to explain that.
No, it does. And then what about so how much right now does the fund have lended out there?
So we're fully allocated. So
Okay.
95% is out on the streets right now.
Okay. And as far as dollar amount, how much is being
Oh,
has
sure.
been lent out?
So the fund, we're currently at $3 million.
Okay.
That's the asset value of the fund. The goal is to get to 10 as fast as possible. That's kind of the number that feels good to me. In terms of hitting that next benchmark. So of the $3 million, we have above that in cash reserves. So the $3 million is fully allocated.
Okay.
Yeah.
Cool. It's neat. And so where do you see this is obviously your current fund, and it seems like it's working very well for you. If you were to look at 3 years, 5 years in the future, what do you see with Eppler Fund moving forward?
So other things that have been kind of notable with the fund, I actually hired my old boss. So I brought him in as like my number 2 here. He's got a great network. He's been in like the Wall Street game for 40, 50 years. So he brings a lot of experience to the table. I bounce ideas off of him all the time. And it's really his job to call on his network and honestly just a second set of eyes. But in the next 3 to 5 years, I'd love to scale this thing in 5 years up to about $50 million. I think that's a fair number to still be doing that with a small team and have a good hold on all the deals that we have in the portfolio. The nice thing about the fund is it's an evergreen fund, so we don't have to launch different vintages every single year. It can all be in the same thing. I also think it's a longer term strategy for people that once you put the money in, you don't have to get the next new thing. You can just keep re-upping and then keep getting your 9% over and over and over again. So I think as from an asset value, as long as the deals are still there and that it still makes sense to invest in the space, I think 50 million is a great number within the next 5 years. I think the team, I'd love to keep the team small. So less than 5 people. So me, some operations people and some sales people, I think would be great. And yeah, I mean, like to me, I feel like I've kind of gotten shiny object syndrome over the years and invested in all these different things. And right now I feel really good about just having the real estate arm and having the fund arm. I mean, the real estate is frankly, I'm on autopilot now, right?
Yeah.
I have my property manager doing all the work. All the loans are automated out. So it takes me, maybe a couple hours a month to do that whole thing. So really just focusing on the fund feels good for me. And I might have a different answer in a year, right? I'm like 9 months into doing this kind of full time. I launched this in March of 2023, but really only went full time in January of this year and left my W-2. So that's kind of where I see it now. But it's definitely been a journey, and the highs and the lows of entrepreneurship are definitely real. So
For sure. Well, no, that's pretty awesome. Tell me a little bit maybe on the back end of this, Craig. So as let's say somebody invested with you, kind of as you were launching, and it's a 3-year investment. And do you have something kind of? Obviously that's being tracked, right? So at some point, where they're going to be exiting the fund and possibly just re-upping, where you don't necessarily have to give the money back. You can just roll it right into whatever the next opportunity is. But I would imagine, is there something that you have, some kind of a structure in place where you see these things start to come up kind of, on your radar anyway, knowing that, okay, this is one that was a 3-year, it's about to, come to maturity. Obviously we'll reach out to the client and find out what next move they want to make or whatever. But are those things, I guess, that you're always kind of paying attention to? I know you've got that cash reserve, you've got the amount that you can obviously pay it back, but it just seems like I'm just curious more on the mechanics of how that fund works.
Yeah, 100%.
From that standpoint.
We have a backend system that tracks all of that. I have a manual system right now. Actively looking for something that's not as manual, but I have a manual system right now that goes out the next 7 years and has all the dates of when we'll need the cash in terms to repay all the clients. So that's manually tracked right now. Obviously, our first investors aren't going to be due until March of next year. So we do have some time on that. Actually, yeah, it is March of next year. But that's like the nuts and bolts of it. There's no sexy way to do it at this point, at least that I've found. I do have a place to track all the investments. It has like start date, end date, but it doesn't give me that map. I'm a very kind of visual person, so I need to see a calendar that says, March of 2028, this much is due, right? Like I like to see that amount on the list there. So frankly, it's a manual sheet right now that has all that tracked.
Okay.
Which is really diving deep in the back end there, but yeah.
For sure, yeah, and more interested just just for my own sake. I'm not sure how interested the audience will be on that part of it, but just curious. So
that's what's at the end, right?
Right. Well, and tell me maybe about how you're growing your investors, but also just as important, how are you growing your clients from the standpoint of being able to lend out this money? Where is that being advertised, or is it all through network, or what does that look like?
Yeah, so the first 3 million that we've raised here is frankly all my network. It's my friends, family, business colleagues that I've done work with in the past, and frankly, I'm kind of reaching that wall of those kind of first tier connections. And now it's time to reach out to that next group. So it's a great. So I just hired a marketing firm actually that will be doing Facebook outreach, Instagram outreach. So you might be seeing the ads, kind of pitching this as a fixed income alternative, something to use as you enter your retirement years. So I'm using that as a marketing piece. I think I just stated earlier that I hired my old boss. Part of his major role is to reach out to his network, and we have in talks of like how many people he brings in, that's kind of part of his overall compensation package, obviously. So that plus me just keep kind of pounding the pavement here is really the kind of 3-prong approach I have currently. There might be more as time goes on. It's difficult, or it's not difficult. You can't pay a commission like you would in other industries per the SEC, the way that I'm filed. So I have to get creative in ways to market, which makes it slightly more difficult. But that's also part of the challenge that makes it fun too, right?
Yeah, for sure. And then what about for the businesses that you're going to be lending to? How do you get to word out to them that, hey, that, at least where you can continue to build that pipeline of potential loans?
Sure. Yeah, I mean, honestly, I'm at a point now where I have a lot more places to place capital than capital coming in the door. I'm not saying it'll always be that way, but it's kind of crazy once you get in on a few of these deals. A lot of these guys are in the same network. We're both part of the same kind of part of the same a mastermind group. So I get some flow from there. But really, I mean, if I were to get a check today, I could probably place the next $10 to $15 million worth of capital right now. So that's not the issue right now. It's more bringing the investors in to invest in a lot of these great projects that I'm seeing. So it's really just network, and it's kind of a cop-out answer, I know, but it's really just kind of asking around. And I mean, I'd look at probably 10 to 12 deals per week, most of which are pretty bad, to be brutally honest with you. Or at least they just, I shouldn't say they're bad. They just don't fit the profile of what we're looking for. So maybe one of those 12 fit the profile, and sometimes the timing doesn't work, so that's a fallout. But I'm honestly constantly looking at different things to put money into the fund, because I feel like the moment that I stop is when there will be a lot of investor capital, and I don't want to have a lot of cash sitting idle, because that's also a detriment to my investors also, to not having the cash put to work, and then that's eating into the cash reserves. So it's a balance of kind of finding the projects and finding the investors, right?
Yeah, for sure. Very interesting. Well, it's a different type of investment for sure, but I love the fact that it's, number one, 9%. It's a great return. Hopefully, very passive, an opportunity for some consistency of just money coming in. And so maybe this would be a good time to tell the audience, Craig, where they can find out more about you if they'd like to invest, and just basically how to be able to reach out to you.
Yeah, no, 100%. Anyone can feel free to email me. I'm at Craig, CRAIG, at eplercapital.com. You can go to eplercapital.com, has all the information. And I'm on LinkedIn, Craig Eppler, or Eppler Capital Funds. Are really the kind of 3 best ways to reach me.
Okay, perfect. Well, this has been great, Craig. I've enjoyed it quite a bit, and I've got a couple more questions for you that I ask every guest. One being, any advice you might give somebody who's just starting out in their investment journey?
Yeah, I think the biggest thing is to take action. I was thinking about this a lot today. I would say I got lucky with the way the real estate market's been the past 4 years, but I also took a heck of a lot of action to get there. So I think sometimes doing the steps that other people won't do can overcome some of the luck. Obviously, luck does play a role into it, but I think if you do take the steps and do the work, then that's a great first step to take.
Absolutely. I couldn't agree more. And how about a book recommendation? It doesn't have to be necessarily finance or real estate related, but it certainly can be. Just something you've read that's been impactful.
Yeah. You probably heard this a lot on this podcast, but Think and Grow Rich is my all-time favorite. I actually give that out to a lot of the younger guys that I talk to as a great kind of first book to read, just from a kind of theoretical perspective. Right.
Yeah, for sure. Great recommendation. Well, Craig, I sure appreciate it, man. This has been good, and thank you so much for being on the Wealth Flow.
Awesome. Thank you so much, Keith. I appreciate it.
Yep. Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.